ready?
Are you ready?
Yeah, let's roll. All right, welcome to another episode of the Greatness Podcast, brought to you by Sky Insurance Brokers. I am Eric Scholey, and with me is my new sidekick today, Mr. Adam Levine, not of Maroon 5, but of Sky Insurance Brokers.
Yes, sir. Hi.
Happy to have you here, Adam.
Thank you, sir.
And today we have a very special guest. The whole community knows her, but I'm going to introduce her anyways. Miss Aurora Mullett of Intrinsic Insurance. Possibly of something different soon, but we'll get to more of that later. But this episode's, we're going to go off script a little bit. We don't have our normal realtor or mortgage superstar guest. We thought it was important to have a roundtable discussion about homeowners insurance in California, or high fire insurance, or whatever other nickname has been given out there by the public and community.
Yeah.
High risk. Terrible insurance. I mean, whatever. I mean,
Unfair plan.
plan. I mean, all of it. So I want to bring on two of really the industry experts, in my opinion. A lot of people know them in the area. We've been blessed at Sky to have Adam running our high fire division here for a number of years. And one of my dear and close friends, Aurora, has been doing an excellent job advocating for the community. She runs a number of Facebook posts to really educate and help and give hope, really, to the public. She's been working with carriers, with the Department of Insurance, and all the above. So I thought, who else better to bring on this so I can just kind of sit back and be quiet and let you guys really talk about what's going on here in this industry. Because, for the last couple of years, we've seen a lot of changes in homeowners insurance in California, the way the carriers look at risks, assess risks, take risk. And then, couple with last 12 months, you've seen a lot of consolidation in the marketplace with carriers. I mean, it just when you think we're getting our footing, more things, tumble or change. So I just want to start off by let's just kind of talk about the current state. I mean, either of you want to start going here, but let's get the conversation going. Aurora?
Well, as Adam said before this came on, the current state is bleak.
Yep.
The insurance marketplace for California, where wildfire used to be just something that was up in the mountains, it is now in the city. We can't place people in Granite Bay. We can't place people in Loomis and Rockland
Eldorado
and
Hills.
Vacaville. Yeah. All these areas that were once considered, or I was told 2 years ago I was crazy for saying you were going to be running into a problem soon. It is now upon us. Yeah. So the normal wildfire market is no longer normal. It is the majority of California.
Yeah, it's definitely become a specialty. I mean, very rarely do I run across an address that I can find a standard carrier for now. We become, at least in my end of the world, I've become more of the fair plan guy than the high fire guy, because that seems to be mostly the only product available these days. The fair plan used to be the exception, not the rule. Now it's more of the rule instead of the exception because of saturation and carriers leaving California and running scared and changing their underwriting guidelines and eligibility guidelines.
I think it's also important to point out, though, because this is a conversation I have with everyone that's not in the high fire areas. Let's talk about the suburbs of Roseville or something like that. Is we've seen major rate increases across the board there because the idea of insurance is risk pooling, right? So all these high fire where people have seen these astronomical increases in rates. But now that, that 3-bedroom, 2-bath house, 1,500 square foot house in Roseville that just a few years ago was $600, is now $1,000+ in a lot of cases. So it's important that people understand that as well. It's a struggle for everyone. And obviously certain areas are, as you guys just mentioned, have been drastically hit harder, lesser options, price increase, but we're definitely seeing it everywhere in the entire state, just from the nature of the business.
We will continue to, as you said, the risk pooling, but insurance companies in California are facing massive deficits, and they're spending and for cleaning up claims, not only with houses, but cars burn up and motorcycles burn up and boats burn up. So the assessment of risk across the entire platform is going to go up. And we have a huge backlog in the Department of Insurance right now with rates due to an election year. And eventually the election will be over and those rates will be increased. And
Floodgates will
these
open.
$1,200, policies that are in Roseville are going to quickly become $1,600.
Yep.
And the policies up in the mountains are going to be in excess of 7,000 plus for a traditional home. So this is the path that we are on. So it's very important that people continue to partner with the companies that are strong in the network. And even if the price goes up $300, you want to look at their claims excellence, because claims and these fly-by-night companies that come into California and buy up the market, it's going to get worse and worse, just like the Florida market.
Yeah, no, we've seen that with some of these insurtech companies come in. They think they have this algorithm that's going to be great, and within 12 months they put block binds everywhere, and then next thing you know, they're non-renewing their entire book. And the unfortunate part is some of these people might have left a carrier they would have been grandfathered in, thinking they're saving a couple $100. Now they're non-renewed, and now they've lost that relationship of that carrier that would have kept them on the book. So, a couple, like you just said, a couple $100 isn't always better. You might want to look at the claim history, the carrier strength, and really their focus here within the state. I have those conversations with people all the time. Everyone always thinks, oh, these insurance people are flying around in jets and they're criminals with these rate increases. And one, I always talk with the client, try to educate them. They have to get these rates approved, so they can't just randomly just throw these magic numbers out. But all these carriers have been just getting destroyed in California. So what they're trying to do is stay in the state. The alternative is they completely pull out of the state, and you get some of these Hartford Safecos that now don't even offer insurance in California. That is not good for anybody. So keeping the competition is important.
Just with the Camp Fire, I believe we're at $37 billion in claims and still rising. The claims haven't all been resolved, obviously. And since then, we've had, 3 major
The
fires?
Lightning Complex, we have Caldor. Yeah.
Those haven't even been assessed yet. But these carriers, like you said, 100-year-old companies, in order to just keep the lights on, they're not going to be making profit for 10, 15 years. They're just trying to keep the lights on and spread the risk to everybody else. I mean, my policy, I've been with a standard carrier for 24 years, and I started out, it was $800 and something a year. It's now at $3,800 or so a year for my insurance. Track home, community, hardened, no trees, hydrants, plenty of hydrants, and distance to the fire station is under 5 miles. No claims, but I'm sharing the losses that company has incurred. It's either that or break up with them, and my only other alternative at this point would be the fair plan, which would be even more expensive. So I'm kind of having to suck it up myself. But I'm just a standard story with everybody out there in California.
Yep, exactly. I just had that conversation with a client the other day. They're in Auburn, and their rate went up about 20%. And I just said that, they made the short list of being renewed up there with this carrier, because this carrier non-renewed about 70% of the clients up in that area. So I would just be celebrating. And then once they understood that, then they were much happier with the rate increase, because the alternative would have been double that with a fair plan or another high-risk policy at that point.
And we're seeing some of at least I've seen recently, got some notifications of some of the carriers that we use regularly have changed their eligibility guidelines, lowering that wildfire risk score. What used to be a 50 is now got to be a 40 or below, things like that. Everybody's trying to tighten their belt.
Well, and they have the performa on the back end that says it's got to have this score, and it can't have a Shia indicator, and it can't have a wood siding, and it can't have an asphalt roof. So even if it's eligible, their rating platform says if these features are inputted in, then we'll say yes. If they're not, then we're going to say no. And that's why home hardening is
on the risk.
very, very important in California.
Exactly.
For people who are looking at ways to help themselves long-term, home hardening is the immediate key to having a long time health of your insurance rates in the future.
Right now, it's really the only option for them to look at right now is what can we do? That's really the only thing, and that obviously still doesn't guarantee them the results they're looking for.
Not yet, but the legislation that is out there, it does. So that's the legislation, the most clear legislation that's coming through states that insurance companies are going to have to offer on homes that have proven home hardening. So
Regardless of the area.
regardless
Okay.
of the area and the fire line scoring, if they have these features that are still being determined, right? We've done a lot of work in the Firewise communities, creating white papers, creating all of the features that are 2.5 hour burn rate or greater. And those features are going to be placed in front of this legislation that says, hey, insurance companies, you now must create a rate filing that accounts for these home hardening. You have to give a credit, much like the wind mitigation credits in Florida. So if a fire line 9 will now be looked at as a fire line 1 or 2 because they have those mitigation credits. So right now everybody's treated the same. You can have trees overhanging your roof, you can have things bedded up. If you're a fire line 2 and a wood siding roof, you get more favorable than a completely wildfire compliant home and a fire line 9.
Yeah.
So it's the risk, the actual risk management is not being perfected right now in the marketplace, and that's why so many people are upset is they're doing the work and they're not getting the benefit of the work.
I had one client recently. He'd been with, it was a major carrier. I won't name who. Been with him for 3 years, about $2,900 a year for a big, huge 4,000 square foot home. He said he spent $20,000 literally removing trees and brush for like an acre around his house, turned his house into a barren wasteland. He got this beautiful home sitting on top of a barren hill, and yet he's still being non-renewed. And he's very upset that he's looking at $10,000, $12,000 as an alternative. And I get it, because he's got a hydrant literally in the front yard. The nearest fire station's like 0.8 of a mile away. He's in a wildfire community, a Firewise community. His house is hardened. It's stucco. It's cement fiber roof. It's got 1/8 mesh on all the vents. And he doesn't understand why he's being picked on. And I have to constantly talk him off the cliff that it's not you specifically. You've done what you can, but we got to work with the tools we have.
Yeah.
And right now we're kind of limited on that.
And for those listening, like when we hear them say protection class or fire line score, this is what carriers, some of the technology they use to score or assess the risk. So that's what they base it off. They use a scoring or number system. Well, one of you guys, for people listening also, I know we've mentioned Firewise communities. Mm-hmm. Can you shed light on what a Firewise community is? Because I think a lot of the public have heard that, and they don't really know what that entails or what goes into a Firewise community.
So there's the National Organization for Firewise, and really it is about the amount of work that a community puts in to not only make defensible space happen for their individual homes, but also along the roadways. Also, so the entire, it's like 80% of a certain community must be wildfire compliant for defensible space. So it's a continual process that has to happen. There's 2 steps to it. First, there's the fire safe. So that's what you become when you create and define your boundaries. And then after so many hours of work and so much defensible space that happens, then you get your certificate for Firewise. And that Firewise is actually very hard to keep every single year. It takes the community a lot of work.
Because
They are keeping track
mitigate
constantly.
brush
Yeah,
all year long.
it doesn't end through that process. And whereas communities, people say, well, Paradise was a Firewise community and Grizzly Flats was a Firewise community. The standards for maintaining that Firewise status is now increased as a result of some of these larger fires. So the defensible space and the features around the first 5 feet to 10 feet of the home, things like that have now widened. So it's even more impactful and more proud for a community to achieve that Firewise status
Right, yeah.
now due to the work that they're doing.
So it's a community focus.
100%
So
community focus.
it's not just one person with a house, but the entire community a percentage. And I know carriers, the Fair Plan included, have been offering discounts if you're in a Firewise community, because the idea is the risks a little bit less to them is the idea of it. But this is also a possible tool that carriers will be able to use to offer credits, much like Hardy in the Home you just mentioned, is Firewise communities. So not only on a personal level, but now you can get the community, town, or city level to try to find some other ways to make this work and long term.
The average has been about 5 to 10% discount with a Fair Plan. I've been seeing an average about 6.5%. Would
Yeah,
you
it works
agree?
out to about 6.5% off of, because it's only off of the fire premium. So the discount is 10%, right? And they are taking 10% off of the fire premium, but the overall policy premium goes down to between 5 and 6.5%, which upsets a lot of people because they go, well, my premium's $3,000 and I didn't get $300 off.
Correct.
So, having that education piece out there for the expectation of that reduction. But still, when you were talking about protection class 10, so no fire hydrant, fire department within 5 miles, those people, most of them are paying in excess of $7,000.
Sure.
The majority of the premium being the the fire. So it can be quite substantial for people.
I'll take 6.5% over nothing.
Yes.
So this is another thing that actually just came up before we sat down to do this podcast that I thought maybe you guys can shed some light on or just talk some more in depth, because this is good information for publics. Is I know the state put in basically non-renewal blocks or moratoriums on certain areas that just had a catastrophic fire. I mean, you can explain this a little bit more. And what is the time frame where a carrier cannot non-renew? Because I think this is important for clients, because sometimes the carriers will still send the letters out, and if the client fights back and goes, no, we're in this, then the carrier has to honor it and renew them. Can you shed light on what that is, how the Department of Insurance or the state came up with this, and how long does that cover people for?
Yeah, so it's actually a bill that was started in El Dorado County by a local supervisor, Mike Rinaldi. He was one of the ones that initiated it.
Shout out to Mike.
Yeah, I have
Definitely.
huge respect for that man. We lost a great representative when he came out of office.
Yeah.
But essentially, it started much broader with a lot of protections for seniors for after so many years of being with a company, they couldn't non-renew you, things like that.
Grandfather did.
And it got whittled down, as many bills do, on the Senate floor, to eventually become that if you were in a declared fire, so that is the key, that must be a declared fire, then from the date of declaration for 1 year, you are protected from non-renewal. So that zip code that was affected and any zip code that is directly surrounding it is protected for 1 year.
1 year.
For 1 year.
After that, it's
Now,
fair game.
it is fair game. Now, the key to this, and where we have a lot of things, is insurance companies have lawyers, and lawyers determine and read these bills differently and push the envelope. And so we have some insurance
Lawyers.
companies that have read it correctly, which states that if your policy is active and under protection, then no notice of non-renewal can be delivered. Other insurance companies state if the policy is set to expire after that protection date, then we can send a notice of non-renewal in that 75-day window beforehand. So we have this battle that is happening with no clear definition from the Department of Insurance to say which is odd, because he's actually the senator that pushed this bill, and he's the one that backed this bill, so he should know it more than anybody what the language of the law should have been.
Right.
But essentially, we have some insurance companies that are pushing the envelope, and they are non-renewing and sending out the notice of non-renewal prior to, like for the Caldor fire, 8/15. So some of those have been reversed because we push back.
Yeah.
Some companies come in and say, we're not canceling you for wildfire. We're canceling you because you have a tree overhanging your roof line.
Yeah, exactly.
They
Right,
look for
and
another
so
reason to get
they-
off the risk.
They do, and so we have also been able to combat that by saying, well, if this home was in the city, would you take the same action? If not, then the consequence is wildfire. Therefore, you're canceling for wildfire, and some of those will get reversed as well.
Yeah. It's all
That's
about
good knowledge, then.
advocating.
So yeah, exactly. So if you're in those areas, just want to educate, because it's good to talk to your carrier or your agent, whoever's representing you, and see if there's some options there if you do get that non-renewal letter.
Because
you were
I know
recently in a catastrophic
Aurora
area.
is just as zealously as I am on the defense for our clients. You know, we
Sure.
get a client
yeah.
that says, I got my non-renewal notice and I'm, in the Placerville zip code, but right next to Grizzly Flat where the Caldor fire is, and we will go to the mat and we'll fight to get that non-renewal rescinded, because it's just not right. And like you said, lawyers get involved. God knows I know that one. Lawyers get involved. Everybody has a different opinion on how it reads. So
Yeah. Interpretation, right?
interpretation.
Interpretation.
Yeah. So So where do we see it going? I know you said like this is a big deal is the election year.
Right.
I hear it from all the carrier reps that come in. Now on the auto side, they're doing a lot of changes because they're not even allowed to take rate there.
Yep.
So it's going to get a little crazy once this ends because like I made the comment the floodgates open, but that's literally what's going to happen on all insurances in California. The auto, the home, everything. We're going to see some drastic increases across the board with all carriers. It's not like it's just carrier specific. This is just the
It's
risk
state
that is
Pacific.
California.
We're in
Exactly.
California. We're literally hell on earth with all the fires every season, right?
Yeah, I mean, you're going to see a major shift upon everything in
Mm-hmm.
California with the way that rate filings are done. I mean, there's a lot of moves that we're doing with trying to deregulate Prop 103 in some cases. Prop 103 was designed for a lot of consumer protection, but it's also one of the major blocks that allows insurance companies to come in and take rate. We're also one of only 3 companies across the United States that don't allow for reinsurance costs into the marketplace. That's another thing that we're striving for in legislation to allow for that. By allowing for that, it actually allows a greater balance of rate filings in California. It allows, if you look at other states that have high frequency losses like these, like Texas, like Florida, all of those companies are able to allow reinsurance costs. And whereas in California, we were protected and we were underpriced for so long due to Prop 103, our mindset is, well, it was $900 and now it's $3,000. This is ridiculous. But in essence, if I write a policy in Tennessee, if I write a policy in Oklahoma and Arkansas, and I tell somebody your policy premium's $3,000 a year, they're like, "Oh my God, that's amazing!"
Yep.
Right? Our perception of what the cost should be is severely. It's been hampered down here in
There
California
needs to
for
be a
a
major
really
shift,
long
yeah.
time.
Yeah.
Yeah, and people need to really understand it's not that. I mean, no one's going to sit here and say that insurance companies didn't make a crap ton of money for a lot of years. But nobody else can sit here and say that there was any way that any of us could have foreseen the level of destruction that has happened in California, that anybody could prepare for that.
Sure.
Right.
So there's a lot of understanding that needs to happen on all sides. But there's also a lot of self-preservation that consumers need to do out there because with higher premiums, with an increase across the board, you're going to have a lot of unscrupulous agents that are going to be out there that are going to be going for premium, not caring if you're protected. And that's the next crisis that is going to be
Yep.
affecting consumers in California. Is there is absolutely zero regulations that are placed on agents to actually write the correct types of policy coverages with, and a lot of people don't understand them. And so there's a ton of underinsured people in this state that don't realize it until they have a loss.
Yeah, and it's, you know my feelings on that. I mean, we're on the same side of the table, but that's been a major issue already that we see, and it's actually one of my rally cries is just trying to protect. Because these agents are, oh man, it's crazy some of the stuff they're writing. It's borderline criminal, and that's what the word I use.
It's
It is
criminal.
criminal, especially when they're in a competitive space and they're insuring these homes so underinsured.
Well, I
Just
think
to
we're
try to
also,
get them, and the people are like, "Oh, I'm still paying $2,000 a year. It must be a good Paul." No,
No.
you can't even
Yeah.
you can't even rebuild your master bedroom for what
Yeah.
you're insured for.
I
It's crazy.
I tell people all the time, it's, people have, as you called it, the unfair plan. People have called that product a substandard product. And I tell people all the time when they mention that, I say, I kind of, for 6 or 7 years into my career, I prided myself on never having to have written a fair plan. I could always find an alternative, but those days are kind of gone. And in that time, I've learned through education, through mentorship, how to write them correctly. And I've learned that it doesn't matter whether it's Safeco or Travelers or Farmers or Fair Plan. The policy is only as good as the person who writes it. If you get Joe Schmo Insurance who just wants to make that commission and wants to beat Aurora's price by $1,000, we all get the same price from the Fair Plan.
Yeah.
He's going to beat Aurora by $1,000. but he's going to be doing it at the expense of the client's coverages. And the client has that faith that this agent is doing right by them. And that's
they're working with a
unfortunately-
licensed professional.
Yeah, that's unfortunately what happened to too many people in Paradise. They trusted that their agent had their best interests in heart, hadn't done a review in 10, 20 years, policy hadn't been updated. But if it had been updated, even the Fair Plan policies, if they were done correctly, it's just as good of a product as other carriers if it's done correctly. If the coverages are there, would you agree?
Oh, absolutely. I mean, and we look at Merced Mutual, which is many people,
That's the
had
litmus test
Merced
for
Mutual,
failure.
and we had access to write Merced Mutual prior to Paradise. But knowing the marketplace and me seeing the rates that they were giving back, knowing what their financial stability was and seeing the losses and where they were acquiring this, we refused as an agency to write this. And many times we lost customers as a result of it. They said, well, you're $1,200 more and I'm going to go ahead and do this. And I would caution them based off of that. And then when Paradise happened, those same people who chose that Merced policy came back to me and said, okay, now what?
Yeah.
You were right. I'm sorry. What do we do now? And it is so more important that in this day and age, you have an agent that understands the marketplace, not just the coverages, but actually takes the time to look at the financial stability ratings of the companies that they're selling and looks at the long-term bonds that they have to repay to see where their ratings are, how often are they being downgraded, because all of those things take into factor the long time, how that's going to perform for you should you have
Survivability.
a master loss that is in there. And as you stated with the California Fair Plan, it's the same rate. And so when people tell me you're more expensive, I say, well, that's impossible. I'm not more expensive. They just put in different coverages. So let's pull up the coverages, send me the quote. Let's go through it. Let's see. Let me explain to you. And the amount of times that a simple premium off of what's called fair rental value, where an agent has told somebody, don't worry about, you don't need that. You're not renting out your house. Right. And it's a lack of concept of what these coverages actually pay for. And people have this false sense of reality that they go to a direct writer. Well, they must know what they're talking about. These agents must know what they're talking about because, I mean, it's the most famous insurance company that's out there.
Right now,
and
it's the only one
unfortunately,
everybody
those direct
knows.
agents don't have the capacity, don't have the training. The number of direct agents that I mentor for free just to protect the community, it's really sad how little knowledge and training that they have.
Yeah, I'm getting a lot of calls from agents that are new to this now because they were
they're trying to avoid
previously
it for as long as possible.
they previously had their product, or if they were a captive agency or not, they had their list of products that they could sell, and now due to saturation or eligibility issues, if they want to survive, they have to start selling Fair Plan, and they come to me for a little education, just like they do for you. And it's kind of scary how many new writers there are out there that they don't have a concept of what they're doing. It's crazy. I see there's going to be some interesting times ahead. Definitely.
So let's take a quick little break, and then when we get back, we'll kind of talk about what California looks like moving forward, a little bit more in depth there, and then maybe end the show with some exciting news as well. So we'll be right back, and on the Greatness Podcast.
Yay.
All right, welcome back to the Greatness Podcast. I'm here with Adam and Aurora, and we are talking about the magical time of California homeowners insurance. So I know we've covered a lot with some technical terms, scoring, credits, some things that the insureds can do, and really just the state of insurance from not only the consumer side, but from the carrier side as well, what's going on. So as we're sitting in here, like you said, an election year is going to kind of prevent a lot of these changes that are going to be occurring. I know you've alluded to some of this possible changes over the next, 2 or 3 years, excuse me. But where do we see from a carrier standpoint, other than some of the force stuff that you were talking about, hardening homes and acceptance and things of that sort? But where do we see the carrier from an industry standpoint? I know, you could see what's happened in some other states that have had difficulties. Let's take Florida, for instance. They're the poster child of this.
Yeah.
California's right there as well. Because, what I'm seeing is insurtechs, like I talked about earlier, have come in. Oh my goodness, this is harder than I thought. Bye-bye, right? reinsurers, their claim rates are through the roof. Insurance, everyone thinks, oh, there's money to be made there. It's not an easy game. And that's why everyone's like, why isn't Google in there yet and all that? And it's maybe someday they're
Google's
not.
smart.
But also they might just be realizing this is a whole different animal state by state. But also what I'm seeing is carrier consolidation on the big side as well. Like I just saw the news today that like State Auto, right, is Safeco's gobbling them up. And and I know State Auto's not in California, but still it's just a big play. MetLife, they got taken out. I mean, you're seeing this all over the place. So what does the long-term health of the industry from the consumer side look like when more and more options now are being consolidated into the big players? Is that a good thing? Is it a bad thing? What's your guys' thoughts on that?
I mean, financial stability-wise, I think it's a good thing. Options-wise, I think it's not going to be a good thing. So if we look at just Safeco versus State Auto, Safeco's underwriting guidelines are a lot more strict than State Auto. So a lot of people who would have had that option is now going to be eliminated through that consolidation. I think,
but Aurora, they're gonna keep them completely separate, not commingled, right? I mean, we've heard those stories,
like
Yeah.
MetLife,
like
Farmers,
MetLife, and then boom, all of a sudden they're
Foremost.
getting hammered by farmers and all sorts of stuff. Yeah.
I mean, we kind of see the writing on the wall when we start to see these. And, when we talk InsurTech, without naming names, when you see these really bizarre names, like you're drinking your insurance company and, these large
on a very
animals
cool animal,
that,
yeah.
like live in the Sahara, those types of weird names that come in, they're doing what we call buy up the market. So they come in and they have underinflated, they bring a bunch of people in, not caring about the long-term health of that customer, really, in essence. And so we're going to see that portion of it. We're going to see a large portion of InsurTechs coming in and then selling off and being acquired by larger organizations where those people might be safe for a year before they're eliminated and they have to find another market. We're going to see larger insurance companies completely limit their underwriting guidelines like they are in Florida, where it says only homes that are 10 years newer, things like that. So there's a lot of consolidation and restructuring that's going to happen that is going to be both good and detrimental. We're going to see a lot of changes with the California Fair Plan, with ways that rate structuring is going through, with the way that coverage is going through. It is going to be probably the next 5 to 10 years is going to be a massive shift in the major players of insurance in California.
And from a pricing standpoint too, like
And
you just
pricing.
said, I mean, the consumer, their mindset of pricing for insurance in California needs to drastically change.
Incredibly.
I have these talks with I know you work with lenders, we work with a lot of lenders, and I have these talks with them all the time they work off debt to income ratios. And they, if they're trying to approve someone up to that limit, it's like they're not giving these households a lot of leeway for these insurance cost increases. Because, I've had this all the time where someone's bought a house and then 2 years later they get non-renewed, and now their insurance instead of $1,200 a year is $4,000 or $5,000. Well, that $300 or $400 more a month is maybe them not affording that house anymore. So
Correct.
So really, it's like
And the
you
foreclosures
need to
will
have-
start as a result
so
of
you
that.
need to have that because you're absolutely seeing that play out. It's going to continue to play out over the next 5 years.
I think we definitely need to, I always got nervous when I heard tech companies buying up insurance carriers. I mean, what does a plumber know about electrical work, right? I don't know anything about tech work. Why should they get involved?
But they're really versed and kind of they're good at both.
Well, they want to get involved in the industry. They see, like you said, they think there's money to be made there, but they really don't have a clue what they're doing. But I see the same thing that you do with dealing with our lenders, that they, in their initial assessment in trying to put a file together, they're just putting in $1,000 for the insurance, as an estimate to kind of see where it lands on the debt to income ratio. And I think we need to educate our lenders to be a little bit more realistic now in California. Maybe they should be estimating the insurance at $3,000 to $4,000 and see if they qualify at that level before going any further, because they're getting blown away too. They're getting the same sticker shock as the client, going, $4,000. I had it, we had estimated $1,000. Well, yeah, if you were living in Rio Linda, but you're talking about a home in Forest Hill.
Yeah.
That's apples and oranges. So a lot of education, I think, is going to be key.
Yep.
It's not so much a lowering of standards, but setting the expectation to be different than the current mindset. The mindset being, I've had $800 a year insurance, and those days are kind of gone.
Well, and for the lenders too, they also have to become more aware and protection of the clients to, if somebody provides back an extremely lower rate
Correct.
on
Question it.
something like the fair plan, they need to step up also and question why that is. If you've been doing it long enough and you've been doing anything up in the mountains, I mean, I look at the difference between a Sacramento agent that comes and says, hey, can you quote this out for me? And I tell them right from the start, you understand it's a wildfire area, it's going to be a minimum of this, versus somebody that
Yep.
is doing it up there all the time, and an El Dorado County agent that goes, wow, that's actually only $4,000.
Yeah.
That's
Yeah.
Only
that's
4,000.
wonderful,
That's
right? So
wonderful.
it is a level that I think as anybody, any realtor, if you're going to really start to become something of a force, you have to become more aware of what the insurance market is.
Right.
Because that's the first step. Whether you are in the mountains or you are in Rockland or you are in Granite Bay, like these are now problems that you have in the marketplace that you have to start accounting for.
Absolutely. Absolutely. And we've actually, from a lender and realtor standpoint, we've broken off relationships before. For
Absolutely.
those lenders that are just, no, we need it down. We need, because they're worried about it. It's like, you're not advocating for your client.
No.
And
No.
that's not how we do business, and we're not getting caught up in that game. So we really enjoy and there's a lot of them, and they've all been featured on this podcast, plus many more. A lot of lenders and realtors that do business right.
Right.
They're absolutely looking not only for the affordability and correct coverage for the client today, but long term as
Right.
well, with that padding that we were talking about for rate increases and everything of that sort.
Exactly.
So making sure that it's the right play for the client from an investment standpoint.
Because the last thing we need to see is a slew of foreclosures, because
Correct.
that first time buyer
we
2
don't wanna
years
wait.
from now, their insurance went up 400% and they can't afford it anymore.
And the fact that the marketplace is risen. So one of the greatest impacts that we have seen now come claims time is that a home that was $300,000 to purchase previously is now $500,000 to purchase, but the rebuild on it's still only $350.
Exactly.
That person is underwater with insurance. And they're not going to be able to, if they have a major catastrophe loss, they're not going to be able to pay off their loan.
Right.
And that's where most people end up losing everything that they have as a result of that total loss scenario and being under with insurance. There's just only so much that we can do to insure them based off of the rebuild versus that
Right.
that mortgage amount. So
10% is still the rule, right? 10% plus or minus.
you talking about dwelling coverage?
Yes.
I mean, it depends on the carrier. Some are 10%, some will allow up to 30%. Because the replacement cost estimator is a guideline.
Right.
It's not an absolute, where that again becomes an insurance agent knowing the marketplace. The insurance agents have to be able to watch the claims trends and say, in these areas, the rebuild is not happening at 250. It's actually happening at 425. Therefore, I must rebuild. I must put that rebuild at 425. Does that mean my insurance policy is going to be that much more expensive for a customer? Yes, but in the end result means that they're going to be able to rebuild. I don't have anybody currently that has gone through a loss that has not been able to rebuild their home
Right.
or pay off their loan, and that's a result of knowing the
Right.
marketplace.
Yeah, we don't want another Santa Rosa crisis, right?
Correct.
Right.
Yeah, where the cost of rebuild got astronomical.
And that's I've been hearing a lot of that in the last year. Carnelian Bay, Kings Beach, the north side of the lake, building costs around 450, 500 a square feet is what
Minimum.
builders are telling insureds there. So
Yeah.
when I'm giving them a quote, and my reconstruction cost estimate comes out at 370 something, they're actually telling me it needs to go up to 450. That's what everybody's telling me, and I'm fine with that. I want them to be part of that conversation. I'm not just going to jack it up to 475 and present it. This is where I believe it should be according to my RCE. And then if you want to adjust it from there, but yeah, you got to know the areas, because that a year ago, I would not have predicted North Lake to be 450, 500 square feet. And that was a paradigm shift easily.
That was a COVID shift.
Yeah,
It was a COVID shift.
Yeah, and that was a shift just in the last year. And some of these other areas, I think Granite Bay is also hitting a higher
Oh yeah.
square footage rebuild
Correct.
cost
Any,
these
any
days.
of the higher net worth homes, right? They're built differently. They're not built with 2x4. They're
Right.
built with
2x6s.
2x6, 2x8, right? So any of those features, if you just default something, it's going to be the lower end of the rebuild. You have to be able to know historically that these homes and these development communities, this is what they built the home with. And that's why it's so hard for a lot of individuals. If they come into the industry, they haven't even had it. They don't even know what they don't know yet.
Right.
And so I try to have patience with other agents to go, okay,
You've been
this is
patient
right.
with me for 10 years.
Right, but it is, right? You have to have that patience and take the time to educate them.
She's not patient with me. So.
No.
Yeah, I'm not patient with most people,
She's
really in general.
my Obi-Wan. She has been for 10 years.
But I have a hard hand, and it's all for the benefit of you as an agent and for consumers. I
Yeah.
often get called the dream crusher because I'm not going to lie to somebody. I'm not going to give them a false sense of hope that this is there. And if I know that,
It's a good nickname. I want to run
right,
with
the
that.
dream crusher,
Right,
it
that's
is.
a marketing.
Right.
I'm thinking of a marketing logo right now for you.
Stickers.
Oh, please. I got the shirt. I got the whole thing coming.
Oh,
out.
yeah. No, yeah, I think our fiduciary duty to our clients, you and I have a very specific ethical belief in how we should handle our clients' needs versus, Joe Schmo insurance down the street who's more fly by night and about getting his commission and not worrying about properly covering. I would rather send a client to a competitor if it's going to be a
Correct.
better product for them than anything I've got. I'll lose the business, but they're going to be protected. And
gotta
I
focus
sleep
it.
good at night knowing that I didn't take shortcuts to make
That's
money.
why we created the agent network,
Right.
right? When I first started the agent network almost 4.5 years ago, other agents were like, "But what's your motive? Why would you give me this client?" And I said, "I'm not giving you a client. I'm
Helping.
providing the information to the client of where the best marketplace
Right.
is. I keep track of every insurance company, what their guidelines are, and if I run an address and I know that State Farm's going to take it over the Fair Plan, there's no way I'm going to put somebody into the Fair Plan. I'm going to I'll tell people if it's $100 difference. I know this company. How many times have I sent you a Mercury client
Yep.
where I go, hey, it's a protection class 10. I know that you're going to be probably $300 to $400 less than Aegis. Yes, I can do it. But that $400
Yeah.
could mean everything
Yeah.
to that customer.
Especially when you're talking about future premium rates.
Yep.
You need to save it now because you're going to get hit with it later when those rate increases come through. And same thing. We both have our own list of, captive agents that we use. And same thing. If I know for a fact that State Farm or Farmers or AAA or somebody else is going to be better than what I have enough difficulty sleeping at night. I don't need
I don't want
sleepless
that on
nights
there.
because I took somebody when I knew they could have gone to another company.
It's not worth it.
Yeah.
So the message of this is buckle up because the next few years are going to
Yeah.
be a little crazy. That's
And
what
make sure.
Buckle up.
yeah.
We'll quote and just kind of summarize this whole
Yeah,
talk with
And
that.
be your biggest advocate.
Yeah.
I mean, I really cannot tell you how important it is for you to start to educate yourself as a consumer as to what coverages are. III.org is a wonderful platform. You can Google what a coverage is listed. It'll tell you how it pays out. It'll tell you everything. But don't believe somebody immediately when someone tells you Fair Plan is if you've called one person and they tell you Fair Plan's the only option, you should always be looking. There's lookups on the Department of Insurance that tell you insurance companies are out there. There's so many ways that you can become your biggest advocate for yourself to make sure that you're protected. And
Agreed.
you consumers have to start doing this.
Agreed. So with that, I'm going to kind of start to end the show, but I'm going to share some exciting news that I think speaks volumes here locally. That it's been a long time coming, but some good things to share. So both Aurora's agency and Sky, our agency, have been huge advocates for the community, for the carriers, and really just trying to navigate this crazy market. We do our best to do business right and always try to put the consumer first for protection, much of what we were just discussing here. So some exciting news is, we've had Adam building out our high fire department where most agencies from the very beginning, like you were mentioning, didn't do the high fire stuff or ran away because they weren't either equipped to it or they didn't feel as profitable. We doubled down from the very beginning. We brought in Adam to run the high fire division, to help lead the way, to educate clients. And we're doing this alongside Intrinsic Insurance and Aurora, as she was leading the way, not only with the carrier standpoint, but an advocate to the Department of
Legislation.
Insurance and the consumers. I mean, she runs the Facebook groups. So I know a lot of people always said, why don't you guys just do this? So it's finally coming, but we're excited to announce that Aurora is officially joining Sky Insurance Brokers. So Intrinsic's going to be acquired by Sky. And I think this is very exciting for a number of reasons. One is it's really going to solidify our commitment and message as a team to the community. It's going to allow us more bandwidth and resources to provide and educate and assist. It's going to free up some time for Aurora to do some very important things on the legislative side, on the carrier side, and the consumer side. And like I said from the very beginning, that was our motto: is we're not going anywhere.
I'm just
We're in
surprised
the
this
trenches.
didn't happen sooner.
That's what everyone will say. I
Yeah.
know everyone's going to say
I mean,
that.
a merger's a big thing. It's a
Yeah.
big, it's a big decision, and essentially we had to look at. For me, I started becoming ineffective at trying to wear as many hats as I was trying to do. So merging and combining forces, it just made sense.
Yep.
It makes sense for everybody involved.
It's exciting. This is a good
Yes.
thing, and I'm excited to see what you guys working in the high fire department build out of there, and just really what we're going to be able to provide the resources we're going to be able to provide is going to be second to none. So looking forward to the
Very
future here.
excited.
Congratulations.
Yes.
Really, really excited to have you join the
Yeah.
Sky family.
I'll
Aurora.
try to only be this annoying, but it'll probably be this.
Now you got to deal with this guy more than I have to deal with him. So
Yeah.
I'm very excited. Thank you for that.
He also has to
In
deal
the
with
last
me.
10 years, she's just been able to be like, talk to me and then hang up. Now she's got to deal
I was
with
pre-menopause, so you got to give me a lot of stuff too. Okay.
A lot going on here.
A lot going
We're
on.
unpacking a lot here on the show. Yeah. We're getting real personal. Okay? That's good.
We're gonna have fun. We're gonna have fun doing what we do best, which we're passionate about, and helping the consumers, providing them. I have a lot of clients that I run across that know Aurora.
Yeah.
Aurora's clients know of me. They're gonna
Yep.
be thrilled
Oh,
to
absolutely.
see this team up.
Yep.
Oh yeah, this is going to be, yeah.
It's like the Avengers.
The amount of people who don't have to feel like they have to choose between their two favorite children
Yeah.
right now.
Yeah, I'm gonna get a lot of hugs. Thank you
Yeah.
Eric, for doing this.
We're the insurance Avengers.
We
We're
are.
teamed up.
No, that's how I view this. This
Wonder
is,
twin powers activate.
for me personally, it's a very exciting move, but I'm more excited for the community with this
Yeah.
because
Yeah.
we got a lot of unfinished business to do, and I'm excited to get to work here because we're not going anywhere.
Yep.
So we're going to be here building this thing as a team, and expect a lot from us and hold us to a high expectation
Yeah.
because we want to be able to deliver on a daily basis.
Yeah.
So,
Yay.
well, good. We'll go team.
Go team.
Go team.
All right, with that, we were going to wrap up the show. Thank you guys for listening. There's a lot in this. I know there's a lot of uneasiness moving forward, but just know Sky Insurance Brokers, Adam, Aurora, our entire team here. We're all here to help. So feel free to always reach out to us, and we love educating. We're the hearts of educators, I always like to
Yes.
say. So thank you very much, and I hope you enjoyed the show. Have a good
Bye.
one.